Week 5, Module 1, we're going to talk about distributions. And I think everybody likes to get a little money now and then, right? We're going to talk about ones that have penalties and ones that are not going to be penalized, but you're still going to want to pay taxes on. Because again, when you have the employer set aside money or you put money that's pre-taxed, it has never been taxed, therefore it will be taxed at distribution. Let's look at some of the options for pension plans. When a participant attains the normal retirement age, which could be 62 at the company, could be 65, could be 59 and a half. Again, you have to look at the plan to see what the rule is. The participant normally gets an annuity for life, and that's kind of standard. Going back to earlier sessions when we talked about the pension plan, and one of the alternates was an annuity. This would certainly show that whether you got the annuity or you got the pension plan, you're still going to get an annuity. Very rarely will you have plans that allow for lump sum payment, because the feeling is if you get a lump sum payment, it probably gets spent right away. So it's sort of a company or retirement plan in many cases saying we're a better judge of what you can do with your money than you can. And frankly, I agree with that, because most people would spend a lot of it when they get it. And I see that, for example, when people leave a company and they take the money from their 401k plan and they use it to buy a car or pay off some school bills, etc. So forcing them to take annuity, in my opinion, is the best way. But again, some plans do allow you to take some lump sum payment. If the participant dies before normal retiring age, the surviving spouse generally gets an annuity. If there is no surviving spouse, I guess all that money paid in is lost, right? Early retirement. Qualified plans and 403Bs. Plan must have early retirement option, and also terminated employees on or after age 55 may take early retirement. So this is sort of a standard I think that most people today are doing. They look at 55 as retirement age. I think it's kind of unrealistic, because again, you've had such a short working career, generally starting in your mid-20s to 55, that there isn't going to be a lot of money in a lot of these funds, unless of course you made it to vice president of a company level or chief executive level. Then of course that's not an issue, but generally 55 is kind of unrealistic for most people. Distribution options for profit sharing plans, and that's the lump sum distribution at termination, and we can take the money as taxable income, which so many people do. Unfortunately, I realize people need money, especially the last 4 years when times have been really tough for people, but then they have nothing for retirement, and they pay a 10% penalty. We can annuitize the value, which makes a lot more sense to me, or we can roll it over into another qualified plan or an IRA, and that of course is going to help you the most for retirement purposes, although probably in many cases is the least method used. As I mentioned earlier, some of the studies done by various insurance companies and mutual fund companies, I guess, also did it, that people generally use the money after they take it out of a 401 or profit sharing plan. Distribution from a qualified plan before 59 and a half, again, that's the magic year. Plans are designated to fund retirement, and we should think of that. Therefore, distributions before 59 and a half are subject to a 10% early penalty withdrawal. There are some exceptions to this rules, which we'll cover in the following slides. I've seen some abuse in this area when I was on a trustee of a retirement plan. It was sort of someone would hire a lawyer and they would write up wordings. It was kind of what I call it a wink-wink type withdrawals. And a lot of times, quite honestly, I thought it was just to get cash rather than the reasons as shown here. But again, we had the documents certified, etc. So what am I going to do? First of all, on all plans, death or disability of the participant, and that should be obvious. In fact, sometimes I wonder, do I just do a disservice by adding it in there, because I think people realize it. And then I've had several people ask me, what happens if someone dies or becomes disabled? Do you lose the money? And again, what's vested you wouldn't know. It can be passed on. Again, it's a life annuity. And that's the problem, is some people have a life annuity, and when they die, there's nothing to pass on to heirs. And people who want to pass on to heirs, therefore, do not want a pension plan with a life annuity. Substantially equal payments over a period of time. And again, I would always check with the plan to see what it allows. Deductible medical expenses, and again, Obamacare will probably modify that one. IRAs also include several. They include a first-time home buyer, which doesn't really mean first-time home buyer. It means first-time home buyer in 2 years. Payment of higher educational expenses for you, your spouse, your children and grandchildren, and health insurance for unemployed. Again, I realize people are taking a lot of money out of the IRAs, they're taking out the other plans too, but what happens when they get to retirement age? And that it's so pitiful when someone comes to my office at 55 or 60 years old, has $10,000 saved for retirement, and wants to retire at 65 and maintain their standard of living. They can't do it. Unfortunately, as I mentioned back in week 1, many people don't realize that. They don't understand that the time value of money concept. I guess they think the money's just going to come out of the air, and then they blame you if it doesn't. Substantially equal payment exception. Let's look at that, because that is been very popular for people, because many of them today at 45, 50 can't get another job. So how do I survive till I get Social Security? And that is going to be these equal payments. And I have one client who actually got a pretty good amount of money out. So for a period when he couldn't get a job, he's about 55. He's in a very unique skill that the demand is very small today, and what they want to do is really hire people in their 20s rather than a 55-year-old. So first you must terminate employment, and you must continue for 5 years at least, or attainment of age 59. And you can even have it longer. For example, the 62 is my judgment, because of the fact that you want to get money coming in until you get Social Security. Flexibility in the determining payment schedule, but fixed once payment stream begins. So once you get the stream beginning, you cannot change it, is basically what it says. Distributing more or less during the prescribed periods result in tax penalty on all prior distributions. And so once you set out that stream, you can't change it. Now, do people try to change it? Yes, because they need more money. And so they take it for today, and it's not there tomorrow, and they get penalized too, 10%. If you have multiple retirement plans, participant must calculate and distribute the minimum of each qualified plan, and the individual has to satisfy required minimum distributions. For multiple IRAs, required minimum distribution can be taken from any IRA. So if you have plans that are separate, you must draw from all of them. Most people, however, when they leave an employer, turn it into a rollover IRA if they're going to continue keeping that money for retirement, and that rollover IRA can have the one plan. I might note that if you're currently working and you're getting retirement after the required retirement age of 70 and a half, you will be able to continue to receive that, or defer rather, that retirement plan where you're currently working. And so a lot of people, what they do is they get their IRAs transferred over to the company plan where they're working today when they're 70 or 75, and they use that money in that company plan to defer receiving or required distributions. So now if a company doesn't allow you to transfer money into your IRA to their plan, retirement plan, then you are going to have to take distributions in that other money. Using an annuity as a payout, life annuity, a participant will not outlive the pension plan. That's the good news. There's no residual value at death. Many people want to leave assets to family members or church or friends, and if you have a life annuity, obviously you can't. And if you have a short life, you don't get much out of that pension. I guess if you have a long life annuity, you want to have an extremely long life to get the maximum out of the pension. Most pensions have joint and survivor annuity provisions. In fact, in traditional pension that's required, it covers the participant and the chosen beneficiary. The ones that are, and I should clarify that, the pensions plans have all been around a long time, require the participant and the spouse both be covered by joint and survivability. But the newer plans and some of the other methods of using joint and survivor can have it for a non-spousal person receiving it. And you can usually have a limitation on the number of payout options. Minimum distribution rule applies to qualified plans, IRAs, SEPs, Simples, 403Bs, and 457 plans. And somebody say, my God, what are all those plans? We haven't covered them yet. That's a problem. We will be covering them next week. Minimum distribution begins at age 70 and a half. Funds must be withdrawn so the IRS can get its taxes on a specific time frame. And these rules do not apply to Roth IRAs, which again we cover next week. Required beginning date of distribution. Required beginning date of distribution is the time that the participant must start taking distributions. Actual date is April 1st of the year following year that the participant reaches 70 and a half. The bad news if you do that is you're going to have two that year. You're going to have the one for the previous year that gave you the April 1st of the year following, and you're going to have the one for that, which means that you're probably throwing yourself into a higher tax bracket, or could be throwing yourself in a higher tax bracket. Therefore, I suggest always that the first distribution year is the year in which one turns 70 and a half. Therefore, start the distribution that year rather than having two the following year. Now, I hate the fact that they do April 1st because most of my clients get that confused. They think it's April 15th because that's when the taxes are due, and I think if they could have picked any day other than April 1st, it would have been better, because I do get clients confused, and the penalty is severe. The penalty is a half of what you didn't distribute that you should have. So if you have to distribute 40,000 and you didn't do it on time, it's a penalty of 20,000, which is significant. Plus, you pay the taxes on the entire 40,000. So, yes, it is. It's a double taxation. And the unfortunate thing is, these are older people who don't understand a lot, and unless they have an agent helping them or a courtesy, so a convenience account, they probably don't comply with the rules very often. Now, I mentioned before the penalty is a 50% excise tax on an amount that's below the minimum withdrawal. Limited exception to 71.5 date for workers working past 70.5 if it's a church or government employee. 403B participants and non-owner participants in qualified plans. So if you continue working, you don't have to take it out on the retirement plan assets that you have in that particular employer. But if you have IRAs from other employers, or you have pension plans or retirement plans coming in from other employers and you're over 7.5, you got to take it out. And again, the exception is if you're 7.5, if it's church or government employees, 403 participants. Calculating the required minimum amount of distribution, use the uniform life tables based on age at the end of the year to get the divisor. Divide the previous year's account balance by the divisor, and the answer is the minimum distribution for the year. I found most brokerage houses today, and Schwab, which I deal with, do give you a report at the end of the year as to how much you got to take out, and based on your age, but it's only based on their particular accounts. So if someone has an account at Dean Weber and have an account at Merrill Lynch and have an account at Schwab, each is only talking about theirs. And again, you have to take it out of each retirement plan, but if you've got IRAs, again, you can lump it out of one of the IRAs, which probably also is very confusing for the older people who have to do it. And I've always thought the tax law really set up to make it very confusing for older people rather than making it easier. And certainly we see that in these type of rules here. Qualified pre-retirement survivor annuities are required in qualified plans, covers the pre-retirement death of a participant with a surviving spouse, and a life annuity benefits equals to 50% of participants' vested account balances date of death. This is a requirement of law today, and it's again to protect the surviving spouse. And it doesn't have the quarter requirement. Remember, in Social Security you had to have 40 quarters. There's nothing here. You could be working 2 weeks after you vested, and that vesting would apply here. Spousal rollover, decedent's retirement account. Use of a spousal rollover option may delay the minimum distributions. What the general rule is, if you die and you have distributions that have been made, they have to be done immediately. There are exceptions for spouses, but my experience, and this is almost 100%, is when someone gets a hold of retirement money, they spend it right away. They don't defer it for their own retirement, and that says that the law spends an awful lot of time spending a bunch of rules on how to distribute and pay out the funds from the deceased retirement plan, and it's easy. That people are just going to spend it right away. In fact, sometimes people spend it before they get it, and then they're hollering at the attorney or the trustee saying, "Why am I not getting the money? I got to write a check to pay back what I spent in anticipation of getting this money." You must be the sole beneficiary of the decedent's retirement account for the special rollover on the spouse, and you can roll the account into your own IRA. So spouses have 3 options, and again, I think most of them take the money right now. One hand is worth 2 in the bush, and even though, yes, you may be going to the next tax bracket, you got the money. And you don't have to worry about the tax returns each year in the future, having to take into account the retirement money you're receiving and the distributions. Spousal use of account. If spouse is the only beneficiary account, they can roll the account into their own name and treat it as their own account, which is the most favorable by far. And that's to their retirement account, not their checking account. However, if the spouse is under 59 and a half and needs access to the account, the 72 rule applies with its penalties for early withdrawals. So if it's only this works if the spouse is 59 and a half, and if they're under 59 and a half, then it's an early withdrawal penalty if they take it off. So in that case, if they're under 15 and a half, then it's probably best to do one of the things, but a series of payments like an annuity, or just lump it into their retirement plan. Again, each client's different. You have to find out their goals and what their situation is. Life annuity purchase. Purchasing a life annuity with retirement account will generally satisfy the requirement of distribution. It also has a big benefit because life annuities will not be taxed, will not make the Social Security money being taxed. Again, if you go back to week 2, we talked about Social Security, and if you have to add all of the various items to the adjusted gross income, such as money paid for interest on education and foreign taxes, etc. But if you have all the money in a life annuity rather than other sources of income, that Social Security will not be taxed, which makes life a lot easier again for older people. It must be annual and non-increasing. In other words, it's a terrible situation as far as I'm concerned, because if a person lives 20 years, there's no inflation there, so each year they actually get less real purchasing value. And joint and 100% to survivor annuities are generally acceptable. So there are these alternatives again that I'm asking people in their 70s and 80s and sometimes 90s to make. And again, I think that they need assistance either from family members, or probably even more so an attorney or financial planner. Death of participant before distribution. In other words, the person is still working, and if the participant dies prior to the required distribution date, the distribution rules are different. The 5-year rule is an option that exercise for all the required distributions to the participants required benefit distribution, and it's usually the least favorable option. Must be used if the participant has no designated beneficiary, has named a non-person beneficiary, or fails to take a distribution in the year following the year of the decedent's death. So that says it's distributed in 5 years, and that's fair, but quite honestly, that's what I see all the time, is people take it right away, as I mentioned earlier. I would say at this end, because I don't remember if I mentioned it later in the charts, but the worst thing is to put it in a trust. And there are big disadvantages to it, plus it's going to cost a lot of money. And one of the things I think too often forgotten by the attorneys and by financial planners is what's going to be the cost to the client for various things we're doing here. And I don't care if it's setting up a plan at a employer's facility and it's a small company getting started, or it's a client individual person. We have to start paying more attention to what that's going to cost them. Distribution to retirement plans due to holder's death. There's tax advantages. Benefit of a plan should be an individual or several individuals. Life expectancy, the oldest beneficiary is used to determine the required distributions, and the beneficiary must be named by September 30th following the year of account holder's death. Again, there's tax advantages, but I very rarely see anybody wants to hold off till the expectancy of the oldest beneficiary. They're going to spend it today. And again, actually it saves them a lot of money because the tax preparers charge more in many cases when they have to handle it. Someone's got to remember it each year, so if you change tax preparers, you got a problem. So just probably the best is to take the money now and pay the taxes now. Quadro, ERISA provides assets in a qualified plan for being assigned or alien in favor of a third party. The exception is a qualified domestic order, which is used for child support, alimony, and property, the rights of the married couples before they were divorced. And Quadro stands for Qualified Domestic Relations Order. It's used at divorces. It's also used later on when people aren't paying their alimony checks or this child support, or they didn't turn over the assets they were supposed to at times of divorce. Then that order can be used to get into the retirement plan. Other than that, the qualified plans are safe. I think people who remember the Simpson trial of a few years ago, when O.J. had a lot of assets in his retirement plan, and the question was whether or not the Brown family could get at him. Rollovers may be able to transfer the account balance if the account into another. Well, let me explain, because I'm not sure what I wrote there. Basically, if you have a balance when you leave one employer in your retirement plan, and it's a defined contribution plan, you can roll it over to your new employer if they accept it, and most do, and if they don't, you can roll it over to an IRA. The key is for the individual not to touch it, to have it rolled directly to the trustee of the plans, and both your IRA account, your brokerage house, or Schwab, etc., will be glad to help you with this, or help your client with this. The key is, if it goes to the client and he doesn't get it into another account within 60 days, he pays the penalty of the 10%. Special options for lump sum distributions. Distributions are generally treated as ordinary income, but some distributions may qualify for one of the following tax treatments. A 10-year forward averaging, and don't get too excited about this because it's not going to happen here, but pre-1974 capital gains treatment, again, don't get too excited, and net realized appreciation treatment. The problem is the person had to be born before 1937, which means that they would be working, they'd be 77, 78 years old, and quite honest, there aren't that many people still working on that. I don't know why, but the CFP board loves to cover this topic, and also the IRS loves to cover it, and I think they all forgot about how old somebody is to be qualified for the 1936 birth. It's based on the following previous charts: special capital gains treatments for the pre-1974 plans. If you're born before 36, again, make you 70. You're still working. Excludes capital gain portions and requires use of 10-year averaging rule. Now, I would suspect if someone was in that position, they'd have quite a bit of money in that account, but I don't know of anybody who is still working who has been in the same plan since before 1974, because it's 35 years ago that they'd have to be in the company. People just don't stay in a company that long. There are some exceptions, but very, very rare. Net realized appreciation goes with it, applies to qualified employer securities. It must take distribution in lump sum, the ordinary income tax on the basis of the stock, which is valued at the time was deposited into the account, and the net unrealized appreciation, the difference between the basis and the fair market value distribution, is taxed at the long-term capital gains rate when sold. Again, that's the pre-1936 birth. Qualified plan loans, I hate this because it seems every client I have who has a retirement plan that allows loans, they don't have to allow them, but if they do allow them, uses it, and somehow, in my opinion, doesn't pay it back, and therefore you got all sorts of penalties, and the reason they don't pay it back, they don't have any money anymore. So it's better, the straight withdrawal, remember, are very limited when you can do that. Usually the only one that makes sense is a series of monthly annual payments for a period of time. But for the loans, what you can do in theory, although again I don't advise it, the rule says it's got to be made available to all participants on an equal basis. There's a limited amount of the loan, which is relatively small, unless it's for buying a house. It must be paid back in a certain time period. It bears a reasonable rate of interest. It must have adequate security, and plan administrators must do proper accounting. There's a lot of these features that are subject to indexing, and therefore I don't want to get any real details on it, other than it is available. You ought to really have your clients think about it, because you got to pay it back, and people think bad. And I'll give you the worst case. Let's say you take one of these loans, and 3 months later you're laid off, or you're fired, or you quit. When is that loan due? And you don't have to be a rocket scientist to answer that question. Qualified domestic relations order, ERISA prevents assets in a qualified plan from being assigned or alienated in favor of a third party. The exception, as we mentioned earlier, is the QDRO, which is used for child support, alimony, and marital rights. Not sure why I repeated it, other than it is a big factor that most people are unaware of. And there's a lot of people who do divorces on their own. They don't hire an attorney because it's mutual and it's cheap as hell. If you don't have the attorneys involved, and you and your spouse can agree on it, or your client and their spouse can agree on it. But they forget about the retirement plan and how it's got to be split. And also, many times people don't realize that the ex-spouse can go after child support, alimony, and property management. In fact, a lot of attorneys forget it, and that's the part that surprised me, is I've had several times clients come in, I said, well, why didn't you go after the retirement plan? And then they went back to the attorney, and he had 5,000 excuses why he didn't do it. The truth is, he didn't know about it or didn't remember it. That ends our week 6, module 1. Start over again.